We're back with Kathryn Rooney Vera, StoneX Group, joining us live. And Kathryn, I was going to say it's sort of competing narratives out there, but it's really more what the market wants to believe from Chair Powell's narrative. Second and final day up on the Hill, basically repeated what happened at the FOMC. Two more to come, two more hikes to come before the end of the year is out. The market initially didn't believe them, obviously. We saw that rebound. But now it's come around to the sense that, okay, maybe it's sort of half serious. There's at least one more hike to come. 77% chance of that is the pricing now for 25 basis points in July. After that, we're not so sure. Where do you stand on this?
Yeah, look, and I've spoken with our StoneX rates team, and I agree. If the Fed needs to start breaking things for things to kind of pan out to their 2% target. We have a 2-10 yield curve that's 100 basis points inverted. So the market really doesn't believe this higher for longer spiel. So if we do in fact remain higher for longer, then we could get a cheapening of the back end of that. So that's why we're kind of liking the steepening trade in the 2-10 steepener. But I'll add one final point is that investors are losing the incentive to be in U.S. equities. I mean, if you look at the yields of the earnings yields in the S&P 500, it's what, 4.7% versus a 3-month T-bill, which is the risk-free asset, which is yielding about 5.20. And that compares to the corporate investment grade bonds, which are yielding 5.5. So the message here, Martin, I think, is that it doesn't pay to take risk right now, especially with this asymmetric risk-reward scenario where I think the equity markets are banking on a Fed that's going to cut rather than continue to hike or maintain 5.5 terminal rate, which is where I think we end for an extended period of time. And they're better placed to remain in more defensive sectors, cash, gold, and alternatives.
So let me sort of try and paraphrase you there, Kathryn, to make sure I understand this right. What you're basically saying is now is not the time to bet on or to go long duration because there's still money to be made at the short end.
Yes, I think that that's the case, and I think that you also, and from the equities perspective, you don't want to be long the high flyers that have done very well year to date. The AI trade has done phenomenally. The SII is artificial intelligence has a lot further to run, but the breadth of the rally in the S&P is almost exclusive to this sector. So I would be cautious with regard to equities, and I would look certainly more towards the fixed income space at this juncture versus equities.
Kathryn, what are the chances of that AI rally broadening out to the rest of the equity market?
Well, if we get the soft landing, Christine, I think, yes, it could. And tactically, there are ways to play the momentum trade, which is to play the laggards, the sectors that have really pulled up the rear versus tech. We have small caps, which have massively underperformed the NASDAQ, for example. So Russell 2000 over the NASDAQ, or you could look at financials, which get decimated by this enormously inverted yield curve. They could be at the catch-up trade. So there are certainly some tactical, I'm talking a couple months, short-term trades that one could play if you think the Fed is going to end up being more dovish or kind of back the markets, which is what we have come to expect over the past 10 to 15 years.
What about the commodities trade? Because China's opening up seems to be a little bit dicey at this point in time.
Right.
And we know that China is a big supporter when it comes to the commodities market. If we get that much expected stimulus coming from Beijing, will that help to stabilize the commodity sector in the second half of the year?
If we get, by some miracle, if we get a massive stimulus akin to what we've seen in previous years, which I put a low probability on, then certainly, roads to nowhere and ghost cities and all of these things that have worked in the past, all signs point to that not being the direction that the Chinese authorities want to go. So rather, it seems that the stimuli are going to be targeted and maybe minimalist in nature because they have longer-term structural goals that they're trying to achieve. So I wouldn't bank on massive stimulus that would require the import of hard and soft commodities. So I would be careful on that trade. I think that's why commodities have had a rocky past couple of months because really the China reopening trade and in fact stimulus has really disappointed.
Kathryn, fantastic talking to you. Thank you so much for being with us today.
Thank you.
Kathryn Rooney Vera from StoneX Group. Squawk Box back in 2.